Now, China is building its next generation of tech champions with new funding to boost domestic sectors and local companies. But new rules on how tech, data, and talent move across borders are also raising questions on what comes next. Now, Beijing just announced last week it'll tighten rules on outbound investment firms from the 1st of July as the tech race heats up. Now, CNA's Deborah Wong has been digging into the ripple effects of that move and joins us now. Deborah, thanks for being on the show. So why is Beijing strengthening this now?
Well, the US-China trade war is spilling into tech, and China is tightening rules to protect what it considers strategic assets, with AI obviously one of them top on the list. And as you can see with what happened with Manners, for instance. Manners was headquartered in Singapore, but it was founded in China. And eventually, when it relocated to Singapore, it was acquired by the US headquartered Meta. But China eventually blocked that deal, and essentially limiting Washington's reach into Chinese intellectual property, Chinese AI. And even though that case happened before the new rules, what it does create are guardrails for how tech companies could eventually navigate. But it's important to note here that the regulations are not just happening in China, it's also happening globally. It's part of an international trend that we're seeing. The EU, for instance, most recently also approving laws to vet foreign investment, specifically in sensitive areas like AI and tech. And the US has barred its own firms from investing in Chinese high tech. And most recently, earlier this week, in fact, it expanded its list of Chinese and military companies, now encompassing a greater spectrum of tech companies. We're talking about Alibaba, Unitree, BYD. So it's not just sensitive technologies anymore. We're also looking at the robotics space, electric vehicle space, in fact. And it just boils down to the understanding that doing business in tech is not so straightforward because it's wide into the geopolitics. Now, I did a story on the Shenzhen startup culture to understand what sort of impact it has on the city. Have a listen.
It's also not another smart speaker. It's not a traditional AI assistant. Welcome, stop by our booth.
It's perhaps a lesser seen side of Shenzhen's tech ecosystem. Chinese startups pitching in English to investors in media from around the world.
我们是将灵感来源于瑞士高端的洁牙技术，把它做了重新的一个设计，让它不再。所以说，我们也希望能够带给北美、欧洲未来的话是全世界的一个人民一个更好的一个口腔护理的一个体验。
From dental devices to AI sports glasses and companion robots, at this showcase, the ideas vary, but the ambition is the same, to go global, although hurdles remain.
Finding money is the hardest part. I think there's many people, even more early stage than these companies, that didn't make it to this stage. So I would say the likelihood of getting investment is low, but here in Shenzhen, the possibility of getting it is higher than anywhere else, I would say, in the world right now, because in Shenzhen, there's a special magic here that people are willing to think big.
That magic, say industry players, sets Shenzhen apart. A tech hub where government funding, venture capital, and manufacturing supply chains come together.
Shenzhen has the fastest innovation cycle. It really compresses the time from ideation, prototyping, testing, user feedback to mass production. They have the talent density, they have all the suppliers.
Founded in 2021, the non-profit InnoX Academy feeds that pipeline. Backed by the Shenzhen government, it trains and incubates China's next generation of innovators, with many showcasing at the event.
Our mandate was to incubate innovative talents and also incubate companies like DJI en masse. We curate our own curriculum from design thinking, how to define the problem, to system engineering, from an idea to technology solution to supply chain network. We have our own fund to invest in them as well. But in the fund, 80% are actually government LPs.
That's part of a broader public-private model, underpinning China's push for technological self-reliance. Local governments also back early-stage firms to drive innovation and for future returns.
推动金融资本向科技企业集聚，狠抓创新链、产业链、资金链、人才链深度融合，发挥国家创业投资引导基金。
But as state support grows, so does scrutiny. From July 1st, China is set to tighten oversight of outbound investments deemed relevant to national security. That extends to tech and data exports, as well as overseas staffing.
Overall, it reflects an increasingly confident China who thinks it has more rights, assets, and technology to safeguard overseas.
The new rules come as the global tech race heats up, and the scene is targeting frontier technologies like AI.
There are many entrepreneurs who have been taking a very conservative stance, even when these, rules were not formalized. There are many people that were very cautious about how they interacted with foreign capital holders and how they were going about expanding abroad. I think what gives most people the anxiety is really how it's going to be implemented.
Consumer tech firms like those at Shenzhen's InnoX Academy are largely outside the scope. But disputes involving Nexperia and Meta's reversed acquisition of Menace have become cautionary tales.
There will be a chilling effect as the compliance risk increases. Compliance burden for companies that goes beyond the borders will have to increase as well, and companies will have to reallocate more resources in dealing with this.
For founders of global ambitions, that is now becoming part of the business plan.
我觉得新规的这样的一个落地的话，我觉得其实也是一个双刃剑。对，一方面的话，可以让我们更加好的去筛选未来可以跟我们长期陪伴的这样的一个合作伙伴。另外一方面的话，确实我们得要好好的关注一下这样的一个条款了。那如果是约束太多、KPI 太多的话，可能会让我们束手束脚。就在前期的时候，创业者来说也科普，就更加多科普一下法律相关的这样的一些知识。
A challenge as China pushes its tech champions outward, at a time when the rules shaping that path are still being defined.
Got lots of cutting-edge stuff happening in Shenzhen, but is such scrutiny on outbound investments actually counterproductive to China's push for its companies to go global, do you think?
I think, if anything, it sets the parameters much clearer for companies to maneuver, to navigate. In fact, companies and analysts that I was speaking to say that it's not going to stop overseas deals because the writing's been on the wall for some time now. Frontier technology, for instance, companies dealing with semiconductor, advanced computing, advanced manufacturing, in fact, they right now have bigger compliance and legal teams. And even for consumer tech companies, for instance, you heard in a story, Esther Huang from Joy, she says that now the geopolitical situation, it's quite unstable. And so because she wants to go overseas, she now needs to expand her knowledge in legal affairs and compliance issues as well. And, it's really all part, if you think about it, all part of ensuring long-term business viability. But there might be some complications when we consider the standpoint, the viewpoint of overseas investors, perhaps given that parties now need to consider compliance risks, not just from one jurisdiction, but from multiple jurisdictions. I spoke to an expert to break this down. Have a listen.
The Chinese compliance risk pulls companies to the different direction which Western governments tends to pull them to, which will remind overseas investors who wants to form a partnership with Chinese partners that they are dealing with a more complicated scenario and geopolitical risk is even higher than before. The bottom line from Beijing is that they are not going to use it recklessly or use it as an active regulatory framework that feeds into all cases and all sectors.
Deborah, one final question before I let you go. Will this, do you think, have a wider impact on the way Chinese firms actually seek funding going forward?
Well, I think for firms, they must now consider a longer time frame. They need to factor in longer approval times as well as more transparency in their reporting processes. It's really all part of a broader shift where Beijing wants to ascertain, tighter control. And we've looked back at 2023. In fact, the Chinese securities regulator actually issued an announcement requiring all red chip companies, meaning to say Chinese companies registered offshore, to get Beijing's approval before listing on the Hong Kong Stock Exchange. And in fact, most recently in March this year, they announced that they required some of these companies to change their domicile back to China before going public. And as for companies with government funding, overseas scrutiny has always been there. So it's not going to shift that much. But when we look at the entire industry overall, these changes are going to be incremental. Companies now need to factor in longer time. The process is going to be more complex, and because it's increasingly shaped by geopolitics as well. But it's not going to deter them from seeking government funding, because analysts have been telling me that that's really going to be giving them a massive capital boost. But beyond that, it's also going to be plugging them to the right networks in order for them to scale up. Have a listen.
For the foreseeable future, that's going to be a very major part of how Chinese companies, innovative startups get funded. And that's partly because there's just a dearth of private risk-taking capital in China, especially after foreign funds have largely pulled out. And two, it's just because that's kind of, it gives you credibility and gives you resources inside of China. Even when you get into things like physical AI and robotics, China is actually, very often the largest market, even for monetization. Therefore, you have to care a lot about the strategic resources you can corral for yourself inside of mainland China. And local government funds are one of them.
Deborah, thank you for that comprehensive report. That's CNA correspondent Deborah Wong in Shenzhen. And that'll do it for business. It's back to you, Telly.
Thanks so much for that, Roland.